Grab Holdings Limited, GRAB, is trading at $3.62 right now, marking a decrease of 1.36% as the intraday session continues to play out. This movement comes on the heels of the company's first quarter earnings report for 2026, which hit the wires just a few hours ago. While the surface-level numbers show a dip, the reality lurking beneath this price action is far more complex than a simple sell-off. Most people looking at their Interactive Brokers trading screens see a stock that is struggling to hold on to its gains, but the expectation versus reality gap here is massive. Investors expected a seasonal slump because of the holidays in Southeast Asia, but instead, Grab reported a 24% jump in revenue to $955 million. The market is currently wrestling with the fact that while Grab beat on revenue and showed record profitability in its on-demand segments, it still posted a net loss that caught some off guard. This is the classic tension that defines an individual brokerage account. Do you sell the news of a narrowed loss, or do you buy the reality of accelerating growth? When you look at Nvidia stock or Apple stock, you see mature giants with predictable cycles. Grab is a different animal. It's operating in a high-growth, high-friction environment across 8 different countries. Today's price of $3.62 reflects a nervous market that isn't quite sure how to price a company that is finally turning the corner on free cash flow. Expectations were for a cautious outlook, yet management just reiterated their full-year guidance for 2026, targeting up to $4.1 billion in revenue. This is a moment where retail investors using the Robinhood app might see a red percentage in panic, but institutional activity suggests a different narrative. The company has already started moving on its $500 million share buyback plan, including a fresh $250 million accelerated repurchase agreement. When a company buys back its own stock at these levels, it's a direct signal that they believe the current market valuation is a disconnect from the operational reality. The narrative for a long time was that Grab would be a bottomless pit for capital, a worry often discussed by those looking for investment help in traditional circles. However, the reality is that they just reported their 17th consecutive quarter of adjusted EBITDA growth. That kind of consistency is rare in the gig economy space. Even with the current intraday drop to $3.62, the underlying business is seeing monthly transacting users climb to over 51 million. If you're checking your SoFi Invest dashboard or looking at Fidelity Investments, you'll see that the mobility and delivery segments are no longer just loss leaders. They are becoming significant cash generators. The mobility segment alone saw a 24% jump in gross merchandise value. The common ground among investors is that the super app model is too expensive to maintain. The contrarian take, which the data now supports, is that the integrated model is actually driving down the cost of acquiring customers, because once someone is in the ecosystem for a ride, they stay for the food and the digital wallet. Recent stock movement has been heavily influenced by the volatility in Southeast Asian currencies and the broader macroeconomic pressures in the region. We've seen daily swings that can be stomach-churning for those used to the relative stability of a Schwab Intelligent Portfolio setup. Institutional activity shows that big players are watching the credit business specifically. Grab's lending portfolio surged by 130% year over year. This is where the real potential for a massive upside or a significant risk lives. They are essentially becoming a digital bank for millions of people who don't have traditional bank accounts. If you're using online investing platforms to find high-growth opportunities, this financial services pivot is the most important part of the Grab story. They are on track to break even in this segment by the second half of this year. Comment below how many shares of Grab holdings you currently hold, or if you think the Southeast Asian market is too volatile for your personal portfolio. Grab's business model is built on 3 main pillars: deliveries, mobility, and financial services. It started as a simple ride-hailing app in Malaysia, but has since transformed into the dominant player in the region, effectively pushing Uber out of the market years ago. They handle everything from grocery deliveries to microloans and insurance. This super app strategy is designed to create high switching costs for users. Once a driver partner is using the Grab platform for their income, their insurance, and their personal banking, they are unlikely to leave. This creates a powerful network effect that is hard for competitors to break. While the past performance was marred by heavy spending on incentives to gain market share, the 2026 reality is one of disciplined growth. Incentives are being dialed back, and the company is focusing on high-value users who spend more per transaction. Looking ahead, the future outlook for Grab depends on 2 main catalysts. First is the full integration of their digital banking licenses in Singapore and Malaysia. If they can successfully convert their massive user base into banking customers, the margins will expand far beyond what ride-hailing could ever offer. Second is the continued expansion of their AI-driven intelligence layer, which they are using to optimize driver routes and dynamic pricing. This isn't just a tech buzzword, it's a literal necessity for survival in cities like Jakarta or Manila, where traffic and weather can change the economics of a delivery in minutes. The risk, of course, is that local governments might introduce new labor regulations that increase costs, or that fuel prices remain elevated, putting pressure on driver earnings. If you are managing your own self-investing strategy through a Fidelity brokerage or a Robinhood stock trading account, you have to weigh these risks against the clear path to profitability Grab has laid out. The reality of 24% revenue growth in a soft quarter is a strong signal. The market's reaction today, dragging the price down to $3.62, might be a short-term fraction to the net loss figures, rather than a judgment on the company's long-term trajectory. Many investors look for intelligent portfolio options that balance risk and reward, and Grab currently sits right in that sweet spot of a former growth-at-all-costs darling, maturing into a profitable enterprise. The contrast between what the market expects, continued losses and high burn, and the reality of positive adjusted free cash flow of $98 million this quarter is where the opportunity lies. Those who only look at the headline ticker on investing sites might miss the fact that the company is effectively self-funding its growth now. They have over $6 billion in cash and equivalents, giving them a massive buffer against any regional economic shocks. Whether you are using the Fidelity mobile app to track your IRAs or the Interactive Brokers platform for active trading, the core question remains, is the Southeast Asian consumer story still intact? Given the 16% increase in monthly transacting users, the answer seems to be a resounding yes. In summary, Grab's current price action is a reflection of a market that is still learning how to value a diversified digital powerhouse in an emerging market. The expectation was for a seasonal dip, but the reality was a report of accelerating growth and a commitment to share buybacks. We've seen how institutional activity is beginning to favor companies that can show a clear path to GAA profitability, and Grab is checking those boxes one by one. The tension between the current net loss and the surging EBITDA and GMV numbers will likely continue to drive volatility in the near term. However, the authority with which management is executing their 2026 plan suggests that the underlying value is building, even if the daily ticker doesn't always reflect it. Keep an eye on the financial services break-even target later this year, as that will be the definitive signal for the next major move in the stock. Using tools like SoFi Active Investing or the Robinhood app to stay on top of these shifts is crucial for any modern investor. The depth of Grab's integration into the daily lives of millions of people in Southeast Asia provides a moat that few other companies can claim, making it a unique but volatile piece of the global tech puzzle. This quick reminder, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Bell subscribe for more updates.